1.2 Components of cash flow. Let's break down the three main components of cash flow. Operating activities. Operating activities involve the day-to-day core business operations that generate revenue. This component focuses on cash flows resulting from transactions related to a company's primary operations. Examples of cash inflows from operating activities include sales revenue, interest received, and cash received from customers. Cash outflows from operating activities may include payments to suppliers, employee salaries, rent, utilities, and other operating expenses. Positive cash flow from operating activities indicates that the business's core operations are generating more cash than is being used, demonstrating operational profitability. Conversely, negative cash flow from operating activities may indicate operational inefficiencies or a cash squeeze, where more cash is going out than coming in from regular operations. Investing activities. Investing activities involve the purchase or sale of long-term assets or investments that are not part of the day-to-day operations. These activities typically include cash flows related to acquiring or disposing of property, plant, and equipment, PPE, investments in other companies, or the purchase and sale of marketable securities. Cash inflows from investing activities may come from the sale of assets or the collection of loans made to other entities. Cash outflows from investing activities may include capital expenditures for new assets, acquisitions of other businesses, or investments in financial instruments. Positive cash flow from investing activities indicates that the company is generating cash from its investment decisions, such as selling assets at a profit or receiving returns from investments. Negative cash flow from investing activities suggests that the company is investing more cash than it is receiving, potentially indicating expansion or growth initiatives. Financing activities. Financing activities involve transactions related to the company's capital structure and financing sources. This component focuses on cash flows resulting from raising or repaying capital from various sources, such as shareholders, creditors, or lenders. Examples of cash inflows from financing activities include proceeds from issuing stocks or bonds, loans obtained from banks or financial institutions, or any other capital infusion. Cash outflows from financing activities may include dividend payments, loan repayments, or stock buybacks. Positive cash flow from financing activities indicates that the company is raising more cash from financing sources than it is using to fulfill its financial obligations. Negative cash flow from financing activities suggests that the company is using more cash to repay debt or distribute funds to shareholders than it is receiving from financing activities. By analyzing these three components of cash flow, stakeholders can gain insights into the sources and uses of cash within a business. It helps assess the company's ability to generate cash from operations, evaluate investment decisions, and understand the impact of financing activities on the overall cash position. Here's a breakdown of the typical inflows and outflows associated with each component of cash flow. Operating activities. Inflows: cash received from customers for the sale of goods or services. Interest received from loans or investments. Dividends received from investments in other companies. Outflows: payments to suppliers for inventory or raw materials, salaries and wages paid to employees. Rent and utility payments, taxes paid, interest payments on loans, other operating expenses, such as marketing or administrative costs. Investing activities. Inflows: cash received from the sale of long-term assets, such as property, plant, and equipment. Cash received from the sale of investments or marketable securities. Cash collected from loans made to other entities. Outflows: purchase of property, plant, and equipment, capital expenditures, acquisition of other businesses or subsidiaries, purchase of investments or marketable securities, loans made to other entities. Financing activities. Inflows: proceeds from issuing stocks or equity instruments, proceeds from issuing bonds or other debt instruments. Cash received from loans or credit lines. Outflows: dividend payments to shareholders, repayment of principal on loans or bonds, purchase of treasury stock, stock buybacks, debt repayments to lenders. It's important to note that the inflows and outflows can vary depending on the specific circumstances and nature of the business. For example, a company may have unique financing activities, such as raising funds through crowdfunding or receiving grants. Additionally, some cash flows may be classified differently based on accounting standards and reporting requirements. However, the above list provides a general overview of the typical inflows and outflows associated with each component of cash flow.